AMD delivered another record quarter. Revenue increased 50% year over year, data center revenue more than doubled, profitability improved sharply, and management expects further acceleration during the second half. And yet the stock fell after earnings. So the important question is not whether AMD delivered good results, it clearly did. The real question is whether those results were strong enough to justify one of the richest valuations in the semiconductor industry. Let's begin with the quarterly performance. AMD generated record quarterly revenue of approximately $11.54 billion. That represents growth of 50% year over year and 13% sequentially. GAAP gross profit increased 103% to $6.2 billion. However, this comparison was helped by an approximately $800 million inventory and related charge recorded in the prior year quarter due to U.S. export restrictions. Profitability nevertheless improved substantially. GAAP operating income reached approximately $2 billion, compared with an operating loss of $134 million in the same quarter last year. GAAP net income increased 163% to $2.3 billion. On an adjusted basis, operating income increased 245%, while adjusted earnings per share increased 246% to $1.66. Adjusted operating margin also expanded from 12% to 27%. So on its own, this was an excellent quarter. The difficulty begins when we consider where the growth came from and how AMD compares with its competitors. Looking at the first half provides a clearer view of AMD's underlying business. Total first half revenue increased 44% to approximately $21.79 billion. However, this growth was heavily concentrated in data center. Data center revenue increased 81% to $12.49 billion. It now represents 57% of AMD's total revenue, this compared with approximately 46% during the first half of last year. In fact, data center contributed approximately 84% of AMD's entire first half revenue increase. This tells us that AMD is increasingly becoming a data center and AI company rather than a broadly diversified semiconductor business. Client revenue also performed well, increasing 24% to $5.95 billion, reflecting healthy demand for Ryzen processors. Embedded revenue increased 12%, suggesting a gradual recovery. Gaming, however, remained the principal weakness. Its revenue declined 15% and represented only 7% of AMD's first half revenue. The overall performance was therefore excellent, but it was highly dependent on data center. That concentration can be extremely rewarding while AI demand remains strong, but it also increases the importance of AMD executing successfully against much larger competitors. This brings us to one possible reason investors were not more impressed by AMD's results. AMD's 50% total revenue growth is impressive. It was slightly higher than Broadcom's latest total company growth of 48%, but it remained well below Nvidia's 85% growth. More importantly, the difference in scale is enormous. Nvidia generated approximately $81.6 billion of quarterly revenue, compared with $22.19 billion for Broadcom and only $11.5 billion for AMD. So Nvidia is growing substantially faster despite already generating more than 7 times AMD's quarterly revenue. That combination of a larger base and a faster growth rate is difficult to overlook. At the segment level, the comparison becomes more favorable for AMD. Its data center revenue increased 107% in the latest quarter, meaning it more than doubled. That is closer to Broadcom's 143% growth in AI semiconductor revenue. However, these are segment figures and should not be directly compared with total company growth. Profitability reveals another important difference. AMD's gross margin was approximately 55.7%, its operating margin was 15.8%, and its free cash flow margin was 20.3%. These figures are reasonably close to Marvell's margins and substantially better than Intel's. However, they remain far below Nvidia and Broadcom. Nvidia's operating margin was approximately 64%, while Broadcom's was approximately 44%. Their free cash flow margins were also more than twice AMD's. The correct conclusion is not that AMD is performing poorly. It is growing rapidly and improving its profitability. But Nvidia and Broadcom currently operate at a much greater scale and convert considerably more of their revenue into profits and cash. That competitive gap becomes especially important when we examine AMD's valuation. AMD trades at approximately 43.4 times forward earnings. That is almost twice Nvidia's multiple of 22 times and considerably higher than Broadcom's 26.5 times. The same issue appears in free cash flow. AMD trades at approximately 95 times forward free cash flow, compared with 44.6 times for Nvidia and 60.7 times for Broadcom. AMD's forward price-to-sales ratio of 11.9 appears more reasonable. but Nvidia trades at an almost identical 12.2 times forward sales. That comparison is difficult for AMD. Investors are paying approximately the same amount for each dollar of future revenue, even though Nvidia currently converts far more of that revenue into operating profit and free cash flow. Broadcom's price-to-sales multiple is higher at 14 times, but Broadcom also produces considerably stronger margins. If you are getting value from this analysis so far, please subscribe to the channel. The strongest argument supporting AMD's premium valuation is its expected earnings growth. AMD's earnings per share are forecast to grow approximately 72.7% annually over the next 3 years. If AMD delivers that growth, its current valuation could gradually become more reasonable. But that forecast also tells us how much future success is already reflected in the stock price. The market's expectations become even clearer when we examine share price performance. Over the last 2 years, AMD's share price increased approximately 270%. That was considerably higher than Nvidia's 110% and Broadcom's 196%, while being approximately in line with Marvell's 264% gain. Intel produced the highest return at approximately 403%, but that was primarily a recovery from a deeply depressed starting price and should be viewed differently from the AI-driven rallies in AMD, Nvidia, and Broadcom. AMD's 270% gain suggests that investors were already expecting a major improvement in revenue, AI adoption, and profitability. The company has certainly delivered strong growth, but so far its margins and cash generation have not improved enough to fully match the expectations embedded in that share price performance. That does not mean the stock must decline. It means future returns increasingly depend on AMD delivering the exceptional growth that investors have already priced in. Another concern following the results was AMD's sharp increase in capital expenditure. Quarterly capital expenditure increased from $282 million to $808 million. That represents growth of approximately 187%, meaning capital expenditure reached almost 2.9 times the prior year amount. For the first half, capital expenditure increased 142%, from $494 million to approximately $1.2 billion. That sounds concerning at first, but it needs to be considered alongside cash generation. AMD generated approximately $5.32 billion of operating cash flow during the first half, up from $2.95 billion last year. After subtracting approximately $1.2 billion of capital expenditure, AMD still generated approximately $4.12 billion of cash flow. Therefore, the Capex increase has not come at the expense of AMD's financial stability. The company has funded the additional investment through substantially stronger operating cash flow. AMD is also a fabless chip company, so this does not represent the enormous fabrication plant burden carried by a company such as Intel. Much of this investment likely supports testing infrastructure, AI systems, laboratories, and AMD's move towards complete rack-scale solutions. Capital expenditure deserves monitoring, but at present it remains manageable. AMD's balance sheet also remains strong. The company has approximately $13.11 billion in cash and short-term investments, compared with debt principal of approximately $3.25 billion. That leaves AMD with an estimated net cash position of approximately $8.8 billion. Its current ratio is approximately 2.6, and its Piotrowski F-score is 8 out of 9. AMD therefore does not appear to have a debt or liquidity problem. However, the expanding business is requiring more working capital. None of these figures currently represents a serious warning sign, but they show that rapid expansion is absorbing more capital and creating larger supplier commitments. Just a quick reminder, this video is not financial advice. My final view is that AMD delivered excellent quarterly results. Revenue growth was strong, data center more than doubled, margins improved, cash flow remained healthy, and the balance sheet is in a strong position. The problem is not AMD's business performance. The problem is the price investors are being asked to pay for it. AMD trades at considerably higher forward earnings and free cash flow multiples than Nvidia and Broadcom, despite currently operating at a much smaller scale and producing substantially lower margins. Its exceptionally strong forecast earnings growth could eventually justify that premium. But after a 270% share price increase over the last 2 years, a great deal of future success already appears to be reflected in the valuation. For me, AMD's valuation looks very high relative to its current financial performance. At this price, the company needs to deliver not merely good growth, but exceptional growth, continued margin expansion, and consistent execution. If you liked the video, give it a thumbs up and subscribe to the channel. I'll catch you in the next one.